From an M&G point of view, we look at global real estate and we need to look at the UK and the rest of Europe in that context. The US, for instance, is pretty advanced in its cycle. It's had now 5 consecutive years of double-digit returns. Compare and contrast that to Europe. I mean, it's pretty early in the cycle, and things are picking up quite strongly. The demand side, the economic side, the advent of QE earlier on this year is all positive news for Europe, and at long last, it seems, there's a lot more appetite from investors, including from overseas markets like the US, where the cycle is a bit more advanced, to go into the next opportunity, and I think the UK and Europe is the next opportunity. Of course, Europe is a big place, and it's not every single market is not at the same point in the cycle. The UK, if you look at London, is also relatively advanced in its cycle, not just from a total return perspective and the investment side, but also on the rental side. And the development side is starting to come back. Other parts of the UK, much earlier in the cycle, and there's a complete lack of construction that's happened over the last few years, driving actually a lack of supply and competition from a resurgent occupier market, and that's pushing rents up. So we're at a much earlier stage in some of the regions of the UK. Similar differences within the rest of continental Europe. So southern peripheral European economies still relatively early in their cycle compared to the core Eurozone countries such as Germany. But we need to be aware of the risks that go alongside this. It's not plain sailing from here. Some of the powerhouse of Germany is in a much less risky place if the European economy was to hit a bump in the road. So a better place there, and we see the cycle continuing for quite some time from here on in. There's a lot of appetite for European real estate, not just in a sort of geographical perspective, but in an asset class perspective. Bonds, pretty low yields and arguably not much value in that market, and so multi-asset class decisions are being made which are favouring real estate. If you look at the gap, the spread between property yields in pretty much all of Europe versus bonds in each of those countries, it's pretty compelling. The income available from property, and income over the long term tends to drive the majority of total return performance. That differential, the income premium that you get from property is pretty attractive. Now, there are some question marks over how long is that going to continue, where bond yields remain incredibly low. Having QE only just started and the ECB committing to another 18 months of that, it's still pretty early days. So we're expecting bond yields to remain low for quite some considerable time, and real estate will almost certainly benefit from that.